Hello, welcome everybody. Welcome to another session of the CISI Level 2 Fundamentals of Financial Services content. This is session number 9 and we're going to be looking at issuing shares and initial public offerings or IPOs. And before we get into the content, I'd just like to introduce one of the sponsors of the session, Matt Sims, who is a Senior Investment Consultant at Mercer. Hello, Matt. Thank you very much for joining us.
Hey, how you doing? Thanks for having us. Just a very quick intro from me, who Mercer is. We're the largest investment advisory firm in the world. We advise over $3 trillion of assets. That's a pretty big number. I personally work with pension schemes, so UK pension schemes, helping them with their investment arrangements. And I mean, my entire career has been doing this. I started after a maths degree into this role. And became an actuary, which meant more exams after graduating from university, even more exams, and finally eventually ended up at Mercer giving advice on pension schemes investment arrangements. I really enjoy the role. I love all things investment, and hopefully you through this course you get a feel for some understanding of what the world of investment can bring.
Brilliant. Thanks very much, Matt. It's really good to have you here. So Matt will be lending some of his expertise and knowledge as we go through. We will speak to Matt as we go through the content. So to introduce the session and what we're going to be focusing on, as I said, this is looking at issuing shares and IPOs. So we're going to look at the reasons for issuing shares or equities, as we would also know them, or stocks. And we're also going to be looking at primarily what an IPO is, how they work, and defining that and looking into that into a bit more detail. So the first thing that we need to talk about is different kind of ownership structures or business structures. The qualification assumes that you know the difference between particular types of business ownership. So we thought it's a good idea to kind of recap on this, or if you don't know that, to talk about this very briefly. So there are a number of different types of business ownership that you might see globally, but also in the UK. And the four most common ones that you find in the UK are kind of sole traders, what we call a sole trader, where you have one business owner and that owner has full control. The other type that fits under the same kind of category would be a partnership. And that's where you have two or more business owners that share the running of the business. The partners may have slightly different roles, and it's a more legally structured form of business where legal documents set out how the partnership is run, who does what each partner is entitled to. And we kind of look at these two in a similar form because we class these as having unlimited liability. And what we mean by that is if the business gets into financial trouble, the owners are seen as the same, in essence, as the business itself. So there's no legal separation between the two. So if the sole trader gets into a debt and has to look at folding up the business, then the debts lie with the business owner, and the same with the partnership as well. So they have what's known as unlimited liability, because the liability of those business owners in terms of repaying any outstanding debts that they have, that rests solely with those business owners themselves. So that's what we know as kind of unlimited liability, and the two types of business ownership that come with that. They are the two kind of more simple types of business ownership to set up. And certainly, as we said, the responsibility and the onus is with those business owners. You can get another type of partnership, which is known as an LLP, or a limited liability partnership. You often see a lot of accountancy firms, solicitors being set up as LLPs, or limited liability partnerships, and they combine what you get with a partnership, but also it provides what we call limited liability, where the partners are only limited to the money that they put into the partnership itself. So that then brings us on to the second two of the four, which basically represent what are known as companies. So we have, in essence, what's known as an LTD, or a private limited company, and these are types of companies where the owners are pretty much also the individuals that run the business and are the main shareholders. So what you have with a limited company is that there are shares that are issued, but those shares tend to be for the original business owners, or they may look to sell those privately outside if someone is looking to invest, might be a friend, might be family, or somebody else that they have contact with. So the shares aren't traded publicly. The general public can't buy them as such. They are limited to a select number of people. And there are less restrictions on private limited companies in that they don't have to have their accounts audited. So there's less scrutiny on what they're doing from a public perspective. And also they don't have to hold something called an annual general meeting, which is mostly known with public limited companies. And we will be going into more depth about what happens at AGMs or annual general meetings in sessions further down the line. Now, the second type of company that you find, which is what this qualification focuses on more than anything, and what we've spoken about previously, is what's known as a public limited company or a PLC. And that's when shares are sold to the public and it becomes a listed company, and you have a board of directors that sits at the top that basically looks after the strategy of the organisation, the strategy of the company, and they run it on behalf of the shareholders. Okay, so the directors are responsible to the shareholders, and that's why they hold, as we mentioned previously, an annual general meeting, an AGM, and that's where shareholders report, directors report on the performance of the business and strategy going forward and things that have happened in the financial year. Now, as we said, with PLCs, unlike limited companies, the shares are traded, generally speaking, on stock exchanges. So they are open to the public. The public can purchase those shares. Investors can buy those via a stock exchange. Also, the difference, there's more public scrutiny because the shares can be sold publicly. Anyone can purchase them. There has to be more transparency about what they're doing. So therefore, their accounts, their reports have to be signed off by an independent auditor. So they have to say, yes, we agree that the performance of the organisation, their income statements, their balance sheets, all of that is true and fair at the end of the financial year. So there is confidence and transparency around the performance of that business. And that's because obviously, if people can buy shares in that company, then there has to be, it goes back to kind of this ethics and integrity topic that we talk about all the time. Those shareholders need to be confident that what they are being told is accurate and true, because that impacts upon share prices, that impacts upon potential profitability, and therefore financial returns may also be influenced by that for the shareholders. Now, the other big difference between a private limited company and a public limited company is the fact that you have the term limited thrown into the title of that organisation. So being set up as a limited company, the owners or the shareholders in this case will have limited liability. So unlike with the sole trader and partnership, with the limited company, either private or public, the business itself is seen as a separate legal entity to the owners or the shareholders. Therefore, if the company gets into trouble and debts need to be repaid and the company and they're in financial difficulty, then it's the company that has the debt with it rather than the shareholders themselves. So the shareholders are only liable to repay or lose the money that they've invested in that company itself through the purchase of those shares. So that's the kind of big differences between these. And obviously, in what we're talking about in this qualification, a lot of what we're talking about in terms of shares, bonds, we're talking about how big PLCs, listed companies, raise money, raise capital through things like issuing shares, issuing bonds, and that's really where the focus is here. Matt, is there anything you want to add to that, or anything that that I've missed out that you think students need to know about?
No, that's a good summary. I mean, I very much focused on that right-hand side of the page, you know, the PLCs, because they're the big companies. They're the ones you can actually invest in. we can't really invest in sole trader type entities because they're small and you can't get access to shares of them. There aren't shares available. So yeah, focusing on those PLCs and how they go about business is probably the most useful area.
Yeah, thank you. And one of the things I sometimes talk about is the fact that sole traders and partnerships, although small and limited companies for that matter, the UK economy is quite reliant on small to medium-sized enterprises, which is why at the moment with COVID-19, the amount of the furlough schemes and all of the support is there to try and support some of these smaller businesses as well as the larger ones, but in essence is there to really try and keep some of these afloat as we go through these difficult times. But yeah, thanks for that, Matt. That's great. So you deal solely with the PLCs, the big listed companies.
Yeah.
Excellent. Okay, fantastic. So one of the piece of pre-session work that you were asked to do for this session in preparation was to look at an IPO, an example of an initial public offering, which is the majority of what we're going to talk about in this session. And that was looking at Facebook, which the Facebook IPO, which took place some time ago now, back in 2012. So it's been a long time since they became a public listed company, or the equivalent in the US. And there were some questions that we asked you to look at about the Facebook IPO, really to explore what IPOs are, why companies do it, and some of the advantages and drawbacks of a business becoming a listed company. So we had this case study of some videos you could have watched as well to help you with this. And some of the questions here that we asked you to answer was, why did Facebook want to go public? So why did they want to facilitate an IPO or initial public offering? What an IPO actually is, what does that term mean? What the role of an investment bank, it mentions investment banks in the case study, and we spoke about investment banks in the previous session. So we were looking at, one of the questions was, what's the role, or summarize the role of an investment bank in that process? And then finally, what were some of the issues that occurred for Facebook after they went through the IPO process? Okay, so Matt, I was going to ask you, why do businesses go through like Facebook did? I mean, Facebook's old hat. It's been around quite some time now. There's a lot of controversy about Facebook as well, isn't there? From they've come under the microscope. In fact, actually, a lot of these big tech firms, which is the kind of term given to them, Facebook, Google, Twitter, they've all come under quite a lot of scrutiny recently. A lot around privacy and things like that. Why does an organisation want to go public and become a PLC and start listing its shares on the stock exchange?
Yeah, I mean, the most popular reason for going public, for doing an IPO, is to raise money. And that might be to raise additional money to then grow, or it might be, in the case of Facebook here, Mr. Zuckerberg owned a lot of Facebook and wanted to effectively get his hands on some of that cash. So if you do an IPO, then the thing is that the shares are listed and then he can sell those when he wants to. The controversial thing about Facebook obviously was the governance structure, the A and B share classes, such that he was able to have it listed, be able to cash in on some of his shares, but he still wanted control of the business. Didn't own the whole thing anymore, but still wanted to control the whole thing. And that's been the case for a couple of these tech shares, as you mentioned. So you effectively can't have your cake and eat it. When it's a private company, you get a lot more control. You don't have to have this regulation. When you step into and do an IPO and step into the listed markets, unfortunately, shareholders, when they own it, they have a bit more control, and they've got certain governance standards you've got to meet. And so, businesses have to step up to that when they do IPO.
Yeah, that's and you've touched upon one of the big drawbacks there, that Zuckerberg tried to mitigate that kind of loss of control with when you go public as a become a company like that. Owners tend to, obviously, because you're breaking up the ownership with potentially millions of shareholders, you can lose that control, and you open yourself up as a company to possible takeovers from competitors and things like that, can't you? So you touch upon some of the drawbacks of a company listing and becoming a PLC or equivalent from a previous ownership structure.
Yeah, I mean, the worst case scenario there for someone that wants to own the company is someone else buys up 51% of the company in the shares and can, boot you out and take over the company themselves effectively. So, there is a loss of control.
Yeah, absolutely, for sure. And you mentioned about the way the IPO was structured in terms of these two different types of shares, the A and B shares. And I can't recall which one had more ownership rights. One had more ownership rights than the other, which was how Zuckerberg got around it in wasn't the majority shareholder, but he had the most voting rights of anyone else. I think he had something like 50% of the votes for in terms of his shareholdings. So yeah, the way that the IPO is structured is also very important, especially to someone like Zuckerberg, as you say. And you touched upon the fact that companies or businesses look to potentially grow, and that the IPO enables that through selling off ownership. So one of the key ways that a business can grow and raise capital is through the issue of shares and breakup of that ownership, and that's exactly what they did here. And we said about why did Facebook want to go public? Well, in the case study, it lists about 5 or 6 reasons as well, which kind of bring in the growth factors. The business wanted to expand and also take advantage of opportunities that it couldn't existingly. And looking at some of those, a lot of it was things like developing or hiring more developers to be able to look at creating technologies that they didn't already have, creating better end user experiences, all those kind of things to try and take Facebook to the next level that maybe Zuckerberg on his own with some people around him wouldn't have been able to have done. I also recommend, have you seen the Social Network, the film?
Yeah, it's good. It's good. The book is slightly better, but the movie is pretty good. Yeah.
I can't say I haven't read the book, but I thought the film was quite an eye opener if they've stuck to the source material and haven't manipulated
pre-IPO period. The bit right at the start is a very interesting story. Yeah, and the name changes and the
it was
the Winklevoss twins you should definitely go and read the book and read all the history of it, because it's had a checkered past, let's say.
Yeah, he's Zuckerberg is quite an interesting character. He kind of keeps himself to himself, but like you said, the Winklevoss twins kind of the whole premise that they had the idea, hired Zuckerberg to develop it, and he basically put a few twists on it and made out that it was his own idea and took it away. And then I think they took him to court. There was a legal battle, wasn't there? And he ended up paying them off, but we don't know exactly how much. I think is the crux of the matter. So quite controversial.
We sit here today knowing how big Facebook is, but I remember back then when it first launched, there was loads of these things. There was Friendster, there was Bebo, there was all, and this will mean nothing to all the viewers of this video because all these other ones died. Facebook became the one. So it wasn't obvious back then that Facebook would become the big monster that it is today.
Yeah, absolutely. And the IPO obviously would have had a big part to play in that, in becoming a listed company and kind of making them much bigger, and raising that money to enable them to do what they did. And like we say, he's a controversial figure, and actually the controversy around Facebook seems to be gathering more and more pace. But and the control that some of these big tech firms have, and the power they have, is quite an interesting dilemma for governments to deal with as we go forward. So in terms of what an IPO actually is, we kind of my fault, we kind of skirted around it a little bit, but the formal kind of definition, if you like, as you probably picked up, is it's when a business goes public and lists its shares for the first time. So it's when it decides that it's going to become a listed company and it sells its shares, divides up the ownership of the company and sells its shares to the public for the first time. Now, PLCs can issue more shares later on, can't they, Matt? They don't have to just stick to the IPO shares. They can list more later if they want to raise more money that way.
Yeah, and that's one of the reasons an IPO helps growth, because it's not the initial sale, the initial IPO, that they're raising more cash. It now gives them access to the stock market such that they can do a rights issue, i.e. issue more shares later and raise more cash for growth.
Yeah, excellent. And with a rights issue, one of the benefits for shareholders, which again we'll look at, is that if a company does decide to do that, then it's the existing shareholders that get the kind of first choice about whether or not they take up the new share offer. So as a shareholder, you get these preemptive rights. So one of those is this idea that if the company decides to issue more shares in the future, you would get the first choice over whether to take up the option of buying those shares. Excellent. Right. So that is what an IPO, in terms of the definition of the term, actually is. Now, we spoke about investment banks in the previous session and some of the roles that investment banks have within the economy and also within financial services. In terms of an IPO, Matt, do you know much about how investment banks get involved with initial public offerings?
Yeah, a bit. I mean, they'd effectively be building a book and underwriting it. And what that means, so that's jargon. What that means is if Facebook is trying to sell these new shares that it's gonna bring to market, they need to find the buyers. And so a bank, before it even IPOs, will go and find buyers for them. That's what's called finding a book or creating a book. So they'll already line up people to buy these shares before the IPO even happens. But more so than that, they'll also effectively ensure the fact that all of the shares will be sold. So they'll underwrite it. So if the shares aren't all sold, they will buy the remaining amount, which leads to an interesting dynamic that if the bank is helping you sell these shares and helping you price it, if they are stuck with it, if it doesn't sell, they're probably going to err on the side of being a bit low on that price, aren't they? So there's a little bit of a dynamic there where you generally get a bit of a pop with IPOs. So they'll price it, the alignment of interest is the banks would price it a little bit lower than maybe would be fair value, so that they don't get stuck with underwriting it if people don't buy it. And so generally you'll see IPO shares rise a little bit in the near term. Sometimes you see them fly on the first day, which that means the pricing's got completely wrong, but sometimes that happens.
Well, and anyone that's bought those shares will obviously be extremely happy if those prices go up drastically.
Sometimes it goes the other way as well, right? Sometimes they get the pricing wrong the other way. So just before anyone takes that as a good thing to go and try and make money from.
Yeah, thanks, Matt. Yeah, so what you're saying in essence is that they really are an investment bank. I think we've spoken about this in previous weeks. The investment bank really takes care of that whole kind of IPO process for the company in terms of price, the price of those shares when they IPO, finding potential buyers for them, and then guaranteeing that even if they can't find them, that they will purchase those shares, so that they've got guaranteed buyers for them as a whole. So it's a really interesting premise. And do you find one of the things that I remember when looking at the listing criteria on the London Stock Exchange, for example, around, if I remember rightly, around 70% of shares don't have to be in the public hands when it's initially listed. So what types of organisations would investment banks go to sell these shares initially?
Yeah, that's a good point. So generally they'll be, they're not going to go and talk to the man on the street to try and sell a couple of shares to them. They want their lives to be as easy as possible. Why don't go speak to the people with big chunks of money to invest, and then they only have to speak to 10 or 20 people, 10 or 20 institutions to get that book filled, to get the IPO away. And so what they'll do is they'll speak to some of the big fund managers. So the LGIMs, the BlackRocks, the M&Gs of the world, the Axis, the Fidelities, and talk to the fund managers there, and then they would invest in their funds. Now, those funds, the actual investors in those funds could be, pension schemes or the likes of you and me, but the actual fund is what will invest in the IPO. And so, the bank only has to speak to half a dozen or maybe a dozen fund managers.
Right. So, the other term, correct me if I'm wrong, Matt, that I often hear used is that organisations like that are known as institutional investors, big buyers of bulk buyers of shares and other financial instruments, like you say, for things like pension funds and sort of investment management firms and that kind of thing that have these big portfolios of shares that they manage on behalf of other companies. Or
so I'd cut that slightly in terms of, yes, institutional investors, but there's effectively two parts of the ecosystem in institutional. So the part that I work with, the asset owners, they are the pension schemes, they are the insurance companies, they are the people, the companies that actually have the money. But then the other part of the ecosystem is the fund managers who run the money for them. And so my role is to help these asset owners pick the best fund managers to run their assets. And so actually in an IPO, it's the fund managers they would talk to, because they're the ones that are going to make the decision on which stocks to invest in, but it's actually they're doing it on behalf of the asset owners. Now, we'd classify all of that as institutional, but there's a slight difference between the asset owner, the actual end beneficiary, and the person deciding on what to buy and sell.
Brilliant. Thanks very much for that clarification, Matt. That's yeah, you're right. Yeah, absolutely. The fund managers are acting on behalf of the investors that place their money with them to make those decisions, because they've got the professional expertise to be able to do that. And I'm also right in saying that every type of fund or every fund has kind of got its own objectives of what it sets out to achieve and possibly what it invests in and that kind of thing. Is that right?
Yeah. So, each fund management firm, so the likes of a Fidelity, will have hundreds of different funds because they're trying to do different things, and certain investors will want certain types of fund structures. So that might be, a fund that looks at very growth type assets. So Facebook would fit nicely in that. But a fund that looks at like value investments, Facebook probably wouldn't fit in there. Or even just geography. So you might have global funds, or you might have UK funds. You might have funds that look at very large companies or ones that look at very small companies. So you really can cut this into a lot of different parts. And so, yeah, depending on what the kind of company is that's IPOing, you'd speak to the person in charge of the types of funds that might invest in it.
Brilliant, thanks. That's really useful for students and also for me to to know as well. So thanks very much. Yeah, so really the investment banks are going to these fund managers and almost selling these shares to them and saying to them, look, it's a great investment. This is something that you need to be looking to put your money into. It's going to IPO on this date, blah, blah, blah. This is the share price, and buy it.
Yeah, they'll literally do a pitch. They'll have a pitch deck. They'll have, all of the good stuff about the company, and go and do a sales pitch to these fund managers and convince them that it's a great idea and they should be buying it.
Brilliant, thank you. And then we come to the kind of last question about this, which the case study focuses and the videos focus a little bit on. And again, these videos, I posted quite a few different videos on the Google Classroom for you to watch about the Facebook IPO. There's also, I think, something on there on the Alibaba IPO, which is the kind of Chinese equivalent of Amazon. And I think there's one on the Google IPO as well. So there's a range of videos on there that you can watch that explains about some of the IPO processes and some of the things that happen there. But Facebook, there were a number of issues after the IPO that caused a bit of a stir with Facebook. So the final question kind of asked what some of the problems were that occurred with that. And Matt spoke about how the pricing of the shares at IPO can sometimes cause a bit of a stir. And as Matt was talking about, the idea that if the investment bank is stuck with these shares, they can't find a buyer for them at IPO, then they might be tempted to keep the price on the lower side, so it's not costing them as much to keep them. So one of the things I think the case study picks up on is that I think literally a couple of days after the IPO, so the shares were priced at $38 a share. And initially, Facebook had said that they wanted to raise, I think it was something like, what did they want to raise? It was they wanted to raise 5 billion initially, but they ended up raising 104 billion from the IPO. And the share price at IPO was $38. Now, I think a few days later, the share price then fell to $31. So it was about a $7 decrease, which wiped about 19 billion off the value of Facebook. And it emerged that one of the investment analysts that was working for one of the investment banks had revised, or she had revised the revenue forecast revenue for Facebook, hadn't told hadn't kind of released that information, or only released it to certain individuals. So it then the Facebook price share price then dipped, which angered a few people. So yeah, it's not, they went without their controversy. And I also believe that there was a problem with because Facebook shares were listed on NASDAQ, if I recall, and there was an issue with the stock exchange system, which meant that people weren't able to buy or sell them effectively because the system was being slow, so there were a number of lawsuits that came about following the IPO with Facebook, which caused a few issues. I don't know, Matt, if you're aware of anything else that happened with Facebook that was controversial.
No, I think that's the main point. I mean, to make it more general about IPOs, if you think about the drawback of becoming a listed company, you have to then do your reporting accounts. You have to be more open. There's more scrutiny. There's more regulation. Well, if you look back, before the company IPOs, it didn't have to do any of that. Yes, it has to give some level of detail on the revenue and reporting, etc. But when you're coming to decide whether you buy this IPO, you don't have the same level of detail and clarity on it as you would if you were just buying a stock that's already been listed for 10, 20, 30 years. And so there's always going to be a bit of difficulty around pricing this stuff. There's always going to be a bit of difficulty around revenue growth numbers and all the numbers around it. But then also, when you've built a book, when the investment banks have sold the IPO to, let's say, half a dozen fund managers, all of the stock is held by a small number of institutions. If one of them decides that they want to sell it all, if it's going up a bit and they want to sell it all, it's going to move around a lot more. It's going to be a bit more volatile. If all of them want to keep it and some more people are trying to buy it, it's going to start pushing it up. So for the first period, the first day, first week, first month, it's going to be a bit more volatile just because it's less widely held. A few years down the line, there's lots of people going to be owning that. There's lots of different people going to be owning it. It's going to, it's not going to be moved around just so much by one person's decision. But in the near term, lots of volatility.
Yeah, and that's we've spoken about the kind of risk and reward associated with shares as well, and that the fact that share prices are so volatile and change consistently or constantly, that actually as an investment, although the reward can be much better than with investments that provide more certain returns because they're less risky, with shares there is that big risk that the share price will drop below what you've paid for them, and it tends to be a much longer term investment than if because I think that the misconception often when we watch things and we see things like Wolf of Wall Street and things like that, it's this or Wall Street, it's buy, sell, and this kind of, you can make money really quickly and things like that. But generally speaking, investing in equities, in shares, is a long-term game, unless you're lucky enough to purchase them at IPO and they rocket up in price.
Yeah, I mean, you have to look at it long term. So your comment about, the IPO for Facebook was 38, I think you said, and it went down to 31, and people got annoyed. Well, I'd love to be buying Facebook at 38 right now, because look what it is now, right? So yeah, they might have been miffed for losing $7 in the short term, but turned out to be a pretty good investment if they just held on to it. So
yeah, absolutely, yeah, indeed. Great stuff, brilliant. Thanks, Matt. It's really useful to hear a bit more about that. So It's just kind of summing up there about the Facebook IPO. As we said, they sold more than 400 million shares at $38 a share, and it raised 104 billion at IPO. We're actually talking there what Matt was talking about there about holding on to the shares. 6 months after the IPO, the shares went down to about half of the original IPO selling price of $38. But then if you jump to January 2015, they were trading at about $75 a share, almost double their initial sale price. And I have to say, I couldn't tell you what the price of a Facebook share is currently.
Look it up. I'll tell you in a second. Let me just look it up. This is the power of apps these days. You can just literally look at your phone and it is $262 this morning. So there you go, not bad since then.
25th of February 2021. Yeah. So $38 a share in 2012. How much you say?
262. Well, it's moving all the time, but 262.
$262 a share. Crikey. Right, there you go. So as Matt was saying, it's a long-term investment. If you want to play the long game, you can sit on those shares, and you're not in a rush to quickly sell them or make a quick buck. You can make a large sum of money if with some of these companies if you sit on those shares once you purchase them. Brilliant. Thanks, Matt. So just to kind of summarize some of that, I think we've kind of spoken about what an IPO is, but just to kind of recap. So an initial public offering, or IPO, is the first time shares of a business are offered to the public via a stock exchange. So in the UK, a company will become a listed public limited company. And remember that when we're talking about shares, the other name given to them, one of the names given to them is equities, which kind of really refers to the fact that you have ownership in something. So ownership of part ownership of a company, if you like. And there's often debate around whether shareholders are really owners because they don't have much say in how the business is run so much. They have some rights that they are given, but they can't make kind of day-to-day decisions of the business. So how much of a business owner are they, if you like? And there's also a lot that's said around the objectives of the board and the objectives of shareholders, and that conflict of interest that you may get with those that are looking to obviously make money from those investments, and the difference between that and those running the company itself in the form of the directors. So that's an IPO. There's another example here about Google. So Google was listed or went public in 2004. And again, NASDAQ, which is the stock exchange that Facebook lists, it's the kind of technology exchange that you find in the US. I can't remember how many companies list. It's over 3,000 on the NASDAQ, isn't it? I think, Matt, something like that. It's huge numbers.
Yeah, it's quite a lot. I can't remember the exact numbers, but yeah, it's lots of.
And it's where you find all the big tech firms, your Microsofts and Apples and companies like that, and the Googles, Facebooks. And this is just another example of an IPO. So Google at the time sold around 19.5 million shares, and they were trading at $85 a share when they raised when they went public, raised about 1.7 billion. So actually quite a lot less than Facebook at the time. But then on the first day of trading, Google shares went up to $1,000 a share apparently, and they were changing hands for about $500 each in January 2015. 11 years later. So if, again, talking about Facebook and the share price now, even back then for Google, if you had those shares when it was IPO'd at $85 a share, and then suddenly in 2015 they're trading at $500 a share, then you are going to, if you sold them, going to be very, very happy indeed. So again, it's another example of a big tech company that has listed, and the opportunities that shareholders get as a result. So I think this just kind of summarizes a lot of what we've already spoken about, really. Just the fact that you find that it's institutional investors and as Matt was saying about the asset managers or the fund managers, should we say, that the investment banks sell to when those shares are initially sold on the stock exchange. They go to those investors first, who then have the opportunity to buy those shares when the shares are IPO'd. So this just kind of summarizes a lot of the points that we've already spoken about. Now, just something else to talk about, just kind of also kind of bringing this together. The qualification talks about primary and secondary markets for equities. Matt, I'm going to ask you for your expertise on this. What's the difference? What's a primary market for shares and what's the secondary market for shares?
Yeah, so I mean, it basically is a primary market is when you're buying it from the company directly. So an IPO is a good example of primary market. Facebook is giving shares to the market is buying it. Rights issues are similar, so when they're issuing more shares. But in secondary market is once those shares are now on the stock exchange, it's buys and sells between individuals or funds or whoever the owner is to the new owner. So it doesn't include the company at all. The company is over there. These are just listed on the stock exchange, and every single day they're changing hands.
Thanks, Matt. Yeah, absolutely brilliant. Very nicely summarised the primary and secondary markets there. So, as Matt said, the primary market is when the company itself sells those shares directly to the shareholders, so via an initial public offering, also known as listed, being a quoted company, floating on the stock exchange or stock market, going public or IPO. There's some of the kind of common terms that you will hear associated with that. And then as Matt said...
Sorry to chip in there. Sometimes it goes the other way as well. So sometimes companies will do what they call buybacks. So if they have a lot of cash on their balance sheet and maybe they think the shares are cheap, shares are undervalued, they'll buy the shares back from the market themselves. Now there's mechanisms around how you go about that, but quite often, big companies will do that, and it helps generate returns for the investors that are left. Because they buy the shares out of the market, basically lock them away, and there's less shares available for investors to hold themselves.
Yeah, that's a really good point, Matt. That's something that we, in one of the earlier sessions, we looked at an article that was written about Apple and about how they liken them to King Midas and how everything they touch turns to money, and the fact that they reverted to share buybacks where they were, because they wanted to try and use some of this cash, they were buying back some of their shares. And I think I recently saw this week that Apple buy a company or take over a company every 3 to 4 weeks or something. Some crazy statistic about how much, the rate at which they're actually buying companies. But yeah, one of the things we did look at in that article that was written was around how Apple were buying back some of their shares to use some of this excess money they have. Yeah, so that's a really good point. So as Matt said, the secondary market is when those shares then are traded subsequently on the stock exchange, and that might be, as Matt said, between the people, the funds that initially owned them, selling them to other funds on the exchange, or to members of the public that are on there, to the investors that want to purchase those shares. And that's what you would kind of see as or kind of generally term as dealing. And that's when those shares are placed or sold again after IPO on a stock exchange. And rather than it being between the company and the investor, it's between investors. So you will get shares sold from one fund to another, or from a fund to individuals, whatever that might be, on the stock exchange itself. Okay, excellent. Thanks very much for that, Matt. So the final thing, again, we kind of, as we've been speaking about the Facebook IPO and about IPOs generally, it's just to kind of summarize with what the benefits and drawbacks are of initial public offerings for the business and the company itself. So I think, Matt has already highlighted some of the drawbacks in terms of kind of opening the owners kind of losing control of the business potentially, unless they've been clever about the way the IPO is structured, like Zuckerberg was. And the fact that that opens you up to being potentially taken over in the longer term, as competitors may look to buy shares in a company with a view of taking it over at some point. So there are some drawbacks with going public, but there are also big positives. So I mean, if we're looking at some of those points, so in terms of benefits, you know, one of the whole main purposes of an IPO is to raise capital, raise money, either to expand or grow, and to use that money for the benefit of the organisation and take it to the next level. So obviously, going public, selling shares, becoming a listed company enables a company to do that. It also increases kind of the public profile of the company. So once you go public, you often become better known, and it raises awareness about the business and the organisation itself. And also another point there is after IPO, it becomes easier to buy and sell shares, but it also becomes potentially easier to borrow money if you want to do that as well. So if we're talking, we'll come on to bonds quite a bit later, but the difference there we've spoken about in terms of shares are ownership and bonds is debt. So these are the kind of two ways that you can raise money through: issuing bonds and borrowing it, or you could break up the ownership and sell shares, or sell more shares after you've gone IPO. So like Matt was saying, through something called a rights issue potentially. So going public makes it easier for the company in the future to raise money, whether that's through borrowing or through issuing more shares once they IPO and become a listed company. As I said, it makes it easier for them to borrow money as well. And in terms of the dangers, we've touched upon this as well, the fact that shareholders and the directors, the board, may come into conflict. So there might be conflicts caused that maybe weren't there previously before it became a listed company. As shareholders are interested in receiving dividends and potentially selling their shares for more than they purchased them for. And again, we'll look at those. We'll look at kind of the financial returns of shares in the next session. But there can be conflicts of interest there between the board and shareholders themselves. We've spoken about the fact that owners can potentially lose outright control of the business. So we've spoken about that and how Zuckerberg kind of tried mitigated that issue. We've spoken about the fact it potentially could lead to a takeover. And also Matt has spoken about the kind of level of scrutiny and regulation that suddenly a listed company comes under, which they wouldn't do as a private limited company or obviously as a sole trader or a partnership. So you've got some other things to consider there in terms of whether or not you IPO and sell your shares to the public. Is there anything there, Matt, that we haven't spoken about that you wanted to that we should raise?
No, I guess the only thing that's missing is there's a cost to all of this as well. So to do an IPO, you're going to have to pay a certain amount of money to the bank to do the facilitation. And then on an ongoing basis, because you have to do all this reporting, you have to meet all the regulatory burden that the IPO and the listing brings, there's a cost to that. You're going to need more accountants, you're going to need more staff to do certain things, you're going to need a board, etc. And so for a company the size of Facebook, that additional cost is not that big a deal. But for a small company, that additional cost might be quite substantial. And so it can be quite a burden for smaller companies.
Yeah, absolutely right. Yeah, thanks, Matt. It's a really good point to think about there, and something that probably we should add to that slide. But yeah, the cost is large, and it's kind of and also the ongoing in terms of things like paying dividends to shareholders potentially. Although part of the issue is that dividends aren't guaranteed for shareholders, there is an expectation that if the company's had a good year, profit-wise, that shareholders are licking their lips thinking, well, we're going to get hopefully going to get dividends here. We're going to get a nice little payout. So yeah, there's all of those things, as you say, and that adds more cost to the business. So yeah, excellent, brilliant. Well, that kind of brings everything to an end in terms of the content here that we needed to cover about IPOs and the issue of shares. Just to remind you that on the Google Classroom there is a small multiple choice test to complete on IPOs, and then in the next session we're going to be looking at the benefits for shareholders, some of which we've touched upon here, but we're going to focus on the financial returns associated with shares. So it picks up very nicely for what we've been speaking about today. I just want to say a massive thanks, Matt, for joining us for this session and your really valuable input to this. We've been really lucky to have excellent people coming in and adding value to these sessions and talking about it from their point of view. And thanks for continuing that upward trend. Really appreciate you coming in and giving us your expertise.
No problem. Thanks for having me.
No worries at all. Thanks very much, Matt. I don't know. I'm not sure if we see you again. Do we see you again or any other sessions?
No, I think you see some of my colleagues in later ones.
Fantastic. Brilliant. Okay. Well, Matt, take care. Thank you very much again, and take care, everybody. And we will see you again very soon.
Thanks, everyone.
Thank you.